Hello my dear listeners, in today's video I will be analyzing the American deficits. I will be making future projections, what is the trend and how this deficit will affect the bond market, crypto market and precious metals. So we have now like consensus around the US deficit that is insustainable, and now the bond market start reacting to this. Like this, you can look the article here, and the projections, regardless of what the American government is screaming about. Very high deficit. I will try to prove in this video there is no possibility to make it smaller. So as they're gonna be making it bigger, because they're gonna be forced to make it bigger because the interest payment and everything else is gonna and tax receipts is gonna get smaller, which is I will demonstrate why. That it will put the pressure on American interest rates. And here, well, I will recommend you to watch this Peter Schiff video.
Sabotage the free market regulations that actually do work. Now, what was going on this week in the market was a continuation of the rise in long-term bond yields. As I've been predicting on this program since before the rise began, this is relentless. And during the week, yesterday in fact, and maybe early this morning, bond yields hit new highs. The yield on a 30-year treasury was now not only over 5%, but over 5.1%. In fact, the high intraday this morning was 5.144%. Now, we did get some profit taking, I guess, people who had shorted bonds, and they made a lot of money this week, short bonds. They covered, I guess, into the week, and there was a rally, not a big rally, but bonds recovered those losses, and the yield on a 30-year closed at 5.089%. This is, again, the highest weekly close, and that would have been the highest close, going back to 2007 since yesterday. So yields are moving higher. The yield on a 10-year momentarily got above 5% as well intraday, just barely, before buyers stepped up and the yield backed off to 5.089. But still, another backup on the week. In fact, the only maturities now on the yield curve that are below 5% are the 5-year and the 10-year. The 5-year is 4.862. But a 3-month, a 6-month, a 2-year, they're all above 5%. And the 30-year is above 5%. The yield curve is pretty flat around that 5% number, but it's not going to stay flat. It's going to steepen out. I expect long-term interest rates to continue the march upward, and we should put more distance between a 90-day, 6-month Treasury bill and a 10 to 30-year Treasury bond, especially the 30-year bond. I mean, that one is going to take the biggest hit. But I think that if this yield curve normalizes by the end of next year, I think that the short rates, which are now around 5.5, they may move up closer to 6. But at the same time, the longer end, the 10 to 30-year, that's going to move up to 7 to 8 at a minimum. Now the question.
Okay, so I will recommend you to watch this video, like to understand. I think Peter explains very well the dynamic, but the point, like if we're moving over 5.5% and 7% on the long-term interest rates, you will see that it's going to be impossible for the government to pay, so they will have to basically implement the interest rate control, and they will have to monetize the debt, and so the inflation it's going to the deficit will make the inflation go higher. We haven't seen the peak of inflation before the collapse. Before the crisis unfolds. So here it's a very good chart I found about monthly interest rate on American debt and average. It's an average, and we reach in August. Last time I was updated, it's 2.9%, but I'm pretty sure because it's rising for about 1/10% every month on average. So we probably reach more than 3.1% in October. So if American debt it's 33.5 trillion, and I take 3.031%. So and well, I just want to see how monthly how much the American interest payment on a debt. So it's if I wanna get in a billion, so that's a trillion. So billion So it's $86.5 billion per month. You know, right now, if I do this, if it's only going to stay at this level, so it was over $1 trillion for the next 12 months. That's only interest paying on American debt. And here also another very interesting statistics. So you have, well, the truth is actually, because you have much more debt that is not really calculated in that 33.5 trillion. So for each taxpayer, it's almost $1 million. Well, in of the debt, because you see in funded Medicare promises and in funded Social Security promises are much higher than, you know, American debt. So you have like the 33.5 trillion. It's only the tip of the iceberg. Actually, what the government has to pay. So we see. I think that's why they, like, you know, they kind of delaying election of the speaker, because they have to start dealing with it, and there is no solution in current political system to fix that problem. Another very interesting thing that also Peter Schiff is talking in his video, it's relation with well, I have a 10-year yields here, and I have a gold chart. Okay, so it's a daily chart, and usually they inversely correlated. When the yields rise on a long-term debt, the gold is falling. But last week, when Peter was making note of that, so if you see here, we have couple days that interest rate been rising, but the gold been rising as well, like for the whole week, and it's pretty much it's very rare. Like, and he's saying that it's going to become a trend, and I agree with him. So because you have. We tend to look on a DXY, but the DXY it's a currencies like a euro, Japanese yen, British pound, Canadian dollar. But you have to look the dollar against the gold, which is, you know, the countries that is not participating in the gold in the dollar trade are using as a reference, and we will maybe going forward use the gold more and more as a reference, because the yield may rise, but the gold gonna be rising, and the dollar might be falling. Well, or remaining stable, but I'm not really paying much attention to the dollar index, because you know, the banks can trick and manipulate the interest rates. They're doing swaps between central banks to stabilize the exchange rates between like different pairs, like a British pound or the euro or Japanese yen, etc. So because it's all in the same block, so the XY can be easily manipulated if needed. Now, like, you know, the government keeps saying that the economy is doing great. Let's listen to a couple businessmen from the ground to see how American economy is doing lately.
And I got a spot for my truck and trailer. Not only that, there are multiple other open spots, and then down on the dealer car lot, open spots everywhere. It typically goes all the way up the road. So what, Greg? Who cares? I care. Now, if there are a lot of dealers here, it means they're selling a lot of cars, which means they need to buy more cars, which means there's more competition at the auction. When there aren't a lot of cars in the parking lot, it means there are less dealers in the auction, which is good for me. Less people to competitively drive up prices, less bidders bidding against me, right? Yes, absolutely, all that is correct. But if there are less cars in the parking lot, it means there are less dealers that need to buy cars, meaning they have enough cars in their parking lot, meaning they have enough inventory, meaning it's not selling, which is why they're not at the auction right now buying. So if they're not buying, they're not driving up the prices, which means the prices are going to come down. That's not what the whole video is about, but it's an idea of what's happening. Now, I don't need to be here today for that exact reason. I have a full parking lot full of inventory and not a lot of selling. I mean, my cheap stuff is selling, and that's about it. I come to the auction because I like coming to the auction. I don't want to miss out on an opportunity to find a golden, to find that meal ticket, to find that lottery ticket. You never know what's going to be here, and I come every week for that reason. I don't really need anything though, because my parking lot is completely full. Now, I try to make these videos once a month. I don't want my whole channel to be doom and gloom, Chicken Little, the sky is falling, oh my god, repo up.
Okay, let's see another one for example.
So I started 11 at night, and by 6 in the morning the next day, my phone started ringing nonstop, and that was years ago, and it never stopped until now. I would say 2 months ago. I would say 3 months ago, I started noticing my phone not ringing as often. I was still getting jobs, no issues at all. I was still making money. Then, I would say about 3 weeks ago, I don't know what it is, I don't know what happened, but everything dropped completely, like 99%. I can tell you, my phone was ringing non-stop, every single day. It would ring so much that I didn't even reply to most people who called or left voicemails, because I just didn't have time. I even contemplated about hiring somebody to actually take care of the phone calls for me, so that way I can concentrate on doing the work and not so much about picking up the phone. But that's not the case anymore. I can tell you, in the past 2 days, I've probably gotten maybe 2 or 3 phone calls. That has never happened before, and that also translates to the jobs that I'm doing right now. For the past 2 weeks, I probably...
Okay, so you see, like, you know, despite you know, the statistics we're getting, and you know, American consumer is strong, American economy is strong, the job market is strong, everything is strong. It's not strong. It's just a political rhetoric to basically to prop up the dollar, and you know, to allow American government to delay inevitable. You know, the delay. Demise of the currency against gold, and demise of the bond market. The bond market, I think it's going to be that's the elephant in the room. That it's about. It's unfolding. Like I think it's unfolding right now, but it's very hard as usually to predict the time frame that it's. But you see the trend. Now how basically what I've been doing, like, you know, I've been. Is taking a position in cryptocurrency. The one that I like the most, it's the XRP. That's, like, you know, the core of my holdings. And you see that, like, you know, this is the weekly chart. It looks very promising. If you look in the fundamentals, maybe in my audience it's not really like in the cryptocurrency, but that's the one. That I think will be doing based on the fundamentals and on a use case in the next bull run, because we will have a bull run before the halving, and all this money that is going to be scared from the bond market. The bond market will not be seen as a safe haven. It will be or at least will be seen as a safe haven less and less. We'll see more and more institutional and big investors start doubting the safeties of the American treasuries on the long run. Okay, so now what we have in the precious metals, basically, well, we have all kinds of deals right now. Like, let's say that's the one. I think that's like for the coins, the Britannias, proving that, you know, basically the people who are buying the precious metals, and I'm feeling this myself because I'm running in the ads to buy and sell precious metals. People don't have money like before. You know, they don't have money allocated to the investment. You have all kinds of deals. You see, this is a American market. Probably, like, this is the I don't know. It's the best deal to it. If you buy 500 rounds, $25.68. Is that the lows for North America or something? Well, I like, you know, this size. Maybe if you buying 100-ounce bars here, well, this is Canada. This is another place I see for the prices. So you see, like, I usually look 100 ounces tier to make my assessment of the market. So, but the trend is here. So basically. American dollars, if you have your savings in American dollars, US treasuries, you have exposures to that, or the currency, and I think the stock market is also will be affected negatively from that. Thanks for watching, and please like the video if you like the content. I'm going to share all the links in the description of the videos.